The Oahu condo real estate market. Prices are dropping and there's a reason why, and there's a reason how you can find yourself a deal and not a headache. And in this video, we're gonna cover all of the red flags you wanna look out for and how you can find yourself a deal. So stick around, get all the details. See you on the other side. What's going on, guys? Patrick Longley here from Team Roger That. And in this video, we're gonna show you why we've seen the condo market take somewhat of a dip. We're seeing days on market increase and how you can look out for some of the red flags that we're seeing in some of these buildings. Now, if this is your first time here, let me quickly introduce myself. My name is Patrick Longley. I'm a licensed real estate agent out here in Hawaii and have been for nearly a decade, helping buyers, sellers, and service members with their real estate needs. So if you have any questions or just need some boots on the ground, feel free to reach out to me. Got my contact information right here, or you can directly DM me on any of my social media platforms. With that being said, let's jump into why the condo market is starting to see a dip and how you can avoid some of the red flags and find yourself a deal. Now, we've seen that in the last year or so, we have seen that the condo market specifically, not the single family home market, but the condo market has taken a bit of a dip and a hit when it comes to appreciation. Now, generally year over year, we see 4 to 15% appreciation every single year. And the last year we saw a 4% dip. So not a market crash by any means, because there's still demand to live out in Hawaii. It's beautiful out here, but we have seen the market soften. We've also seen that the average days on market has gone from 14 to 20 days, closer to like 40 or 50 days. Now, some properties we're seeing sit for 6 months, even a year, but we have seen the condo market specifically soften. Now, with the softening market, we're seeing days on market increases, we're seeing price cuts, we're seeing sellers offering credit, which can help with your closing costs or even buying down your rate. But at the end of the day, we need to ask ourselves, well, why is this happening specifically to the condo market? So let's go into why is the condo market softening? Now, the reason why the condo market is softening is we're seeing that the entire market is softened a little bit. No crash by any means, but we've seen it soften a bit simply because of interest rates. Interest rates are a bit higher than where they were of the COVID days when it was at like 2 or 3%. Now we're seeing something closer to 6.5%, which is a significant difference to your monthly payment when it comes to purchasing a home. So that alone has softened the market. But there's something more specific and red flags you want to look out for when you're purchasing a condo and things that we can help you with. So let's cover why the market specifically for condos out here in Hawaii has softened. The first one is insurance premiums. So since the Lahaina fires and issues we saw in Florida, we have seen insurance companies really take a huge hit in their payouts. Insurance companies generally don't want to pay out much. So when they start having to pay things out, they start re-looking at their books and going, okay, what states and what cities are riskier assets where we should charge a premium because they are a higher risk of something happening, like a hurricane, like a flood, or maybe it's an older building that needs to be repaired. These are things that these insurance companies are looking at. One issue that we're seeing out here in Hawaii is a lot of the buildings, specifically in Honolulu or Waikiki, are older buildings. And because they were built in the 70s, they're most likely gonna need updates to the plumbing, to the elevator, to spalling, painting, re-asphalting things, the roof. These are all things that generally have maybe a 20, 30, 40, or 50-year lifespan if they were built in the 70s. If they haven't already been fixed, then it might be somewhat of a concern or risky asset for these insurance companies. So what they've done is essentially increase their premiums and charge that to the association. And what the association does, it goes, oh shoot, we have to have insurance coverage. Well, it's gonna cost us a lot more. Well, who's gonna pay for it? The owners, and they pay for it through the maintenance fees. Now, we'll later get into those maintenance fees and how they're softening the market, but let's get into the next thing, which is softening the market, which is going to be projects. So like I said before, a lot of these older buildings, generally built in the 60s and 70s, are gonna have projects that are coming up because it's inevitable. A lot of these certain items are at the end of their lifespan. So that could be the modernization of the elevator, that could be the plumbing stack that needs to be replaced, that could be the roof. These are all items that are at the end of their lifespan and could cost millions of dollars to replace. And if the association wasn't managing their books and didn't save money for a rainy day, they would potentially have to do one of two things. The first thing is a special assessment. Now, this is a very scary word, special assessment. What it actually means is that, hey, we don't have enough money and we need to fix this elevator and it's gonna cost $6 million. And everybody who owns in this building is a part owner of the building. So everybody has to give us $20,000 right now. And that can be very scary. And that can be something that can dilute the property value or also slow down the market specifically for that building. The second option they have is to get a loan from the bank, which is what we see a lot of these associations doing because nobody wants to get a $30,000 check. So they'll get a loan in a high interest rate market and get a loan to help pay for some of these items that need to get fixed. That loan payment It's very important to understand what the terms are and stuff, but that loan payment would essentially be spread across all the owners in that building, a lot better than a $30,000 payment, but something that's going to increase your maintenance fees. And the third thing that we're seeing that is, again, kind of softening the condo market is maybe the insurance premiums have gone up, but also what we've seen is certain buildings do not have full coverage or enough hurricane insurance coverage. And because of that, some certain financial products, for example, Fannie Mae and Freddie Mac, they will not allow you to get financing to purchase in a building that doesn't have 100% hurricane coverage. And if that happens, then you have slimmed down your buyer pool to cash buyers, portfolio, or ironically, VA loans. And that is another reason when you slim down your buyer pool, you'll see the appreciation rate slow down, go flat, or in some situations even go down. And that's another reason why we're seeing the condo market soften, is because we don't have enough insurance coverage for these financial products to utilize on that building, slimming down your buyer pool. Now, subtle note for my service members who are using their VA loan, ironically, you would think the VA loan would be something that is super strict on what buildings you'd be able to purchase in, and if it doesn't have full coverage, you should not be able to buy in that. But ironically, we've found that VA loans can buy in these buildings. But I always review these buildings to tell my clients, hey, you can purchase in this building with your VA loan, but keep in mind that the appreciation rate might slow down, might go flat, or even go down because the buyer pool is literally only VA buyers, cash, and portfolio, and a large portion is conventional. And if they can't get financing in this building, you may not be able to sell this property for top dollar in the future if they don't get it. So even if you can get financing for it, if you're using a VA loan, it might be something you want to step back and look and go, okay, I'm buying this from an investment standpoint. If other buyers can't buy this, unless they're service members using their VA loan, maybe this isn't the best investment. So me and my team, we always like to review these condo documents. We always like to look in the building to see, okay, is there other people purchasing with conventional loan? Ask the lender, can we use a conventional loan if we wanted to buy one in this unit with conventional loan? These are all things we would like to look at because yes, it might be great that you can buy that property with your financial product, but we need to make sure from an investment standpoint that other people can as well. And another thing that we've seen that has softened the market is, again, going back to those projects, is going to be certain amenities. So you might have a building that has a bunch of great amenities, but they might be older. That might be a pool, that might be a sauna, that might be a tennis court. These are all things that are great, but they're gonna need to be repaired or maintained. So these are things that, of course, the association and the maintenance fees, that's what they all pay for. To cut your grass, to pay the security guard, to repave the tennis court, to do maintenance on the pool or the jacuzzi or the sauna. These are all things that generally it's better to find a building, especially if it's older, that doesn't have a lot of amenities, because those are amenities that need to be maintained, and those maintenance costs will get passed over to the homeowner. Now, all these items that I listed off, whether it's the buyer pool that can be utilized, but it generally comes back down to the maintenance fees. So we've seen that maintenance fees have increased significantly, where on average we would see somewhere between 4 and 15% every single year. That was the average. But just in these last couple of years, with these insurance premiums, with these projects, with people getting loans to fix some of these projects, we've seen them jump anywhere between 20 to 25%. I've seen some as high as 90% in 1 year. That can go from a $600 monthly payment up to a $1,200 overnight. And that has scared a lot of sellers, where they see their HOA go up significantly, and maybe they are on a fixed income or they can't afford such a large jump, and they just decide to sell the property. And that's why we're seeing lots of inventory increase. We're seeing buyers be a little bit more touchy when they're looking at a building and looking at a unit, where they're not just looking at the unit itself, but actually looking at the finances of the building, what the increases are. And these are all things that we assist our clients with. So the next thing we want to go over is we understand what's going on in the condo market. We understand that there's some deals to be had, and we understand there's some red flags of things you want to avoid, so you're not taking over somebody else's headache. Now, what is it that me and my team do to protect you and ensure that you're getting a deal and not taking over somebody's headache? Well, let's jump into that right now. The first thing we like to do is take a look at the building itself. We like to look at the sales of the building the last couple of years, and we like to look at what the HOAs have been increasing over the last couple of years. Has it been staying on pace 4 to 15% every single year, or are we seeing large jumps happening? And if we're seeing large jumps happening, why did that happen? These are all things that we dive deeper into. Sometimes we'll do that before even putting in an offer, so we don't waste your time or the seller's time. The next thing we'll do is we'll get the condo documents. Generally, you'll get the condo documents, which is a stack of documents that goes over the rules, regulations, but more importantly, the finances. We like to look at the finances, have a better understanding of how much money the association has in the bank account, have an understanding if they have any loans, if they have any litigation that if they lose that they're gonna have to pay out. It might increase your HOAs. We like to look at the finances to understand where they are currently, what things may be coming up in the future, and how that may affect you as a buyer and how it may affect your maintenance fees. The next thing we like to look at, as I mentioned before, is what buyers can buy in this building. Is it only cash, portfolio, and VA? Again, that's gonna slim down your buyer pool. Or are we seeing past transactions and current ones presently who are using conventional financing? So do you have access to the open market when you need to sell the property. The next thing we want to look at is the insurance coverage. What type of insurance coverage do they have in the building? Do they have 100% hurricane insurance? Do they have only 10%? Do they have a very high deductible? These are all things you want to look at because these are things that can affect the financing products and potentially affect you if there's a large issue in the building. Another thing we like to look at is the reserve study. So the reserve study is going to be something in the condo documents that essentially is going to spell out the next 30 years of projects that may be coming up based on the age or the lifespan of some of the items in the building. Again, elevator, spalling, the asphalt for the parking lot, roof, plumbing. These are all things that they can say, oh, this was put in 30 years ago. It's a 35-year lifespan. This is how much it's going to cost most likely to replace it. This is how much money that you have. You're most likely going to have to get a loan. And then we kind of dive deeper into these hypothetical situations. Have they already gotten a loan for those projects? Have they shopped for that loan? Have they not even discussed getting a loan? Where are they going to get this money? Now, when you're looking at these buildings, when it comes to the projects, because that's an important aspect, you're usually going to be in one of three camps. The first camp, which is probably the best scenario to be in, is, yep, we had projects, we got them done, we either got a loan or we increased HOAs, and that fee has already been baked in and the projects are completed. Perfect, that's great. We already know what we're stepping into. There's no surprises. On the flip side, you have somebody that says, yeah, we have projects. We don't know when we're gonna do them. We don't know how much they're gonna cost. We don't know how we're gonna fund them. And we don't know how much it's gonna increase your maintenance fees. That's not the best scenario to be in. And then you have somewhere in the middle, which is, yeah, we have projects, we've already gotten a loan, we know how much more or less it's gonna cost, we know how much it's gonna increase maintenance fees, or they can give us enough information to hypothetically basically look at the loan terms and what that would calculate in regards to your ownership percentage or PCI and help our clients understand, okay, we know that there's projects coming up. We know they're gonna cost X amount of dollars. We know that they've got a loan and it's most likely gonna be calculated to this amount in your increase in HOAs. And another thing that we do is we like to look at the average of the HOAs in that area. If you're buying a property and it's on the higher side of HOAs and none of the projects have been done, that's a bit of a concern. But if it's on the higher side of HOAs, but all the projects have been done, then that might not be as much of a concern because it's already been baked in. We know what it is. And most of these buildings that are on the lower side, we double check, but a lot of them probably haven't had the projects done yet. And that might actually have a higher cost because we've seen with tariffs and increases of cost of goods and labor that could increase significantly. And the last thing that we always suggest our clients to do, especially when we're buying a condo, specifically in Honolulu or any building that's built in the 70s or 80s, is we have this company right here who will actually review the condo documents, review the finances, give their third-party opinion, somebody who doesn't have a horse in the race, and let you know what their thoughts are on that building, the health of the financials, what they expect the future plans of the finances in that building to be, what you could expect the maintenance fees to increase based on the information provided. So we highly suggest any of our clients, when they're buying a building that's a little bit older, 70s or 80s, that they most likely have this company right here review the documents. Their cost is about $500, but could save you a huge headache. And again, give you a third-party opinion with somebody who doesn't have a horse in the race to let you know what their thoughts are on the financial health of that building. So that's a little bit of what we're seeing happening in the condo market, why the market is softening when it comes to the condo market, what it is we do for our clients to ensure that they're getting a deal and not taking over somebody's headache. So if you guys have any questions, feel free to reach out to me. Also, if you got any value out of this video, do me a huge favor, smash that like button as well as click the subscribe or notification bell so you get notified when I drop videos just like this. And if you have any questions about real estate or the condo market or anything when it comes to real estate out here in Hawaii, feel free to reach out to me. Got my contact information right here, or you can directly DM me on my social media platforms. I'm Patrick Longley with Team Roger That. Hope you guys have a beautiful day. I'll talk to you soon. Aloha.